Hi, welcome to the Market Alert for Wednesday, the 13th of January 2016. And starting off in the 5-minute chart for yesterday, first trade was a 21-point loser. The market coming back to the psychological line there of 16,552, having moved sharply higher in the pre-market session. There you can see the market just moving all in one direction, and then decided to put the brakes on at the point that the main session came on stream. So the market then moving sharply down these price bars out of the range to actually give a signal. A lot of volatility until we got towards the quieter part of the session. We then had this short here, which actually was a profit at the time, but for some unknown reason, as you can see there, it's gone down through the scalp. For some unknown reason, it's showing up as a black one there. I don't know why, but I will certainly get Paul to have a look at this, the programmer, because that definitely was a winning trade, because I actually did the trade and I had a recording of it. But when I came back from dancing last night, saw nothing had happened in the evening session, and these two trades were quite simple affairs. Deleted it, which of course Murphy's Law. I really could have done with that today, just to show you that it did actually trade down to there. But you can see it's traded down to the scalp level there, so pulling back the loss there. And the evening session, of which I'm never around on a Tuesday, you can see there the market being brought back, and same thing there now, the market moving back to the upside. So in the daily chart, we've got a bit more support here, and price is starting to move back to the upside there, which you can expect. I mean, you're going to get a bounce. They're known as technically known as a dead cat bounce. Dead cats bounce, but they don't run away. The background to this market now is one of weakness, so any up move now will be considered an opportunity to actually sell into. There's not a lot apart from printing more money that the Fed can do, because all of these markets are central bank run at the moment. And therefore it's a case of being able to sell into the rallies. The bigger the rally, the better. But at the moment, the first upside target would be 16,757, but that is also dependent on a few other factors at the moment of the market being able to move higher, which we'll come to in just a moment. On the news front today, crude oil inventories. This has gone from a medium impact news item to now a high impact one. I wonder why. Well, we'll have a look in just a second. This is out at 3:30 p.m, so keep an eye on this one. And the reason this has gone from a medium impact to high impact is because of the precipitous drop in the crude oil price. This is the 4-hourly chart, and going back to the 31st of December, you can see it was $37 a barrel within that area. We've lost $8 in the last 8 or 9 trading days on the crude oil market. And of course, this is backed up by the news as well. BP fires 4,000 as oil slump deepens. Forget $20 oil per barrel, says Standard Chartered. Prices could fall as low as $10 a barrel. What a buy that's going to be when the market gets down to that level. You don't get too many chances coming along in trading the markets where you know the downside risk is virtually taken into account. And if it does go down to $10 a barrel, I think the last time it did that was 1998, if I recall. I know we have been down to this level before, and I'll look that up for you for tomorrow and show you the chart. So we have been here before, but to different circumstances now. Of course, you've got this massive global slowdown in the background. And again, the Baltic Dry Index making new record lows as well, which you can see there yesterday. Now 402 from those highs even of a year ago. There you can see all the way down 1500 down to 402 on the Baltic. And the commodities index as well, up slightly today, but when you look at the 5-year, you can see that we have a serious problem in the commodities markets, major slowdown occurring there. Also, the Shanghai market, we've broken it. It's happened whilst I'm recording. We've broken the 3,000. We need to stay below this level now convincingly. Let's have a look at a yearly chart. We had a low in August, if I can just get this to stay there, of 2927. So that's the next downside target that's got to be broken in the Shanghai market, which of course will then see further selling Yesterday the market had a look at this area as well intraday, but came back. But a convincing break below 3,000 will take you all the way down to 2,000, no doubts about it, because this is where the bubble was created in the Shanghai market. So it'll go back to where it started, as the Nasdaq did in 1999. So finally, on the old implied volatility, 1847, it's had a couple of days to breathe as the market's moved higher, depending on what China does this morning. Now, of course, if we have another 7% drop or more in this market, then we could see a bit of downside pressure in the pre-market session as well, but they're doing their damnedest to hold it at the moment. And make no mistakes, if we get down to the August lows, the plunge protection team are going to come out with as much ammo as they can to try and bring the market back. So again, this indicating that we have room to move to the upside at the moment as it's pulling back. But that said, the issue we've got is this now breaking the 3,000 there, the Shanghai taking out the 3,000 psychological level. So moment at 9 points below it, and a case of just waiting to see what happens throughout the morning session. And if anything does, I will let you know, and just keep an eye on that one. Right, that's it for today. I will see you in tomorrow's market alert as ever. Thanks for your support, also for watching. See you in the next one.